Okay, so now let's talk about the direct write-off method, or what we call as a non-GAAP method. So we can simply say that bad debt is recognized only when the account become uncollectible, which is like you recorded in January your accounts receivable of $1,000, but in the month of May you know that there will be a bad debt of $20, then only you will be recording it, and this will be recorded when it actually happens. So simply this direct method says that bad debt is recognized only when the account become uncollectible. Now the non-GAAP compliant, because why, fails to match the expenses with related revenue. Generally this method don't matches with the matching concept what we use in the accounting principle, and here it overstates the accounts receivable as well. So let's try to understand this thing through example. So in the case of Amazon company, on September 10 year 1, Amazon records a credit sale of $25,000 to a marketplace seller for advertising services. Okay, so Amazon will be receiving this $25,000. Now on May 15th year 2, seller goes bankrupt and account deemed uncollectible. Now what will happen in direct write-off method? Simply the Amazon will be making an entry that the bad debt expenses are debited by 25,000 and accounts receivable is credited by 25,000. This is debited, why? Because this is an expense and all expenses are debited, and we need to cancel the accounts receivable, because as per the principle, if our assets I can say our assets are reducing, then we credit them. That is the basic principle. If assets are increasing, we debit them, and if assets are decreasing, we credit them. So our accounts receivable are reducing right now, so it has been credited. Now what has happened? Result is like revenue of year 1 not matched with the expense of year 2. Why? Because in year 1 we show that we are having credit sale of 25,000, so in our PNL 25,000 was showing as a revenue in year 1, but in year 2 this revenue is not showing up, only the expense, or I can say bad debt of 25,000 is showing in year 2. So it is not matching in the same year in which the revenue has incurred. So this method is generally not acceptable because this does not follow the matching principles of accounting.